Scale is the blockchain that is simply built different. Other L1 networks have costly transaction fees, clunky user experiences, and lack true adoption in AI and on-chain gaming. Explore the gas-free ecosystem at skale.space/ecosystem and follow their journey on X at Scale Network. That is Scale with a K. Hit the link in the show notes to get started. Hey everyone, Jason here. Wanted to talk about something that's been on my mind a lot recently. We should not be just recreating the TradFi industry. That's why I'm excited to share with you that today's sponsor, Magic Eden, is getting into token trading, and their vision is to become on-chain Binance and then much more as the entire world moves on-chain. Stay up to date with Magic Eden's journey by giving them a follow on X at Magic Eden. Tired of losing track of all your tokens? Uniswap Wallet is designed to easily manage, store, and swap your crypto all in one place. Access thousands of tokens across Ethereum and more than 10 other chains instantly by using Uniswap's wallet today. Download it today. It's available on Chrome, iOS, and Android. Hit the link in today's show notes to get started. Hey everyone, Jason here. You've heard me talk about today's sponsor Mantle a lot this year, and I wanted to just take a quick second to really highlight them. With over $1.6 billion in total value, locked in a massive $2 billion treasury, Mantle has become one of the fastest growing networks in crypto. Through groundbreaking protocols and strategic partnerships, Mantle is really transforming what is possible in DeFi. To stay up to date with what's going on in the Mantle ecosystem, give them a follow on X at 0xmantle. Hey everyone, Jason here. For Black Friday only, Ledger is offering $70 in Bitcoin if you upgrade to the Ledger Flex. You can also save up to 40% on selected Ledger Nano wallets and accessories. Offer is only valid until December 5th or while supplies last, so be sure to hit the link in the description of today's episode so you don't miss out on this really good deal. All right, everyone. Welcome back to another episode of Empire. We are trying something new today. So we have Ben and Kevin from ParaFi. I guess maybe I should start. Kevin, Ben, welcome to the show.
Thanks, Jason.
Yeah. Okay. So yeah, of course. Yeah, good to have you guys back. So I went to the ParaFi LP summit the other day, and Kevin and Ben gave this beautiful presentation on predictions for 2030, and it was I think sometimes as the industry gets so focused on these little micro things or these little things that are, this meme coin moved 10% this day, or, what is this election doing to the stock market today? And I think sometimes we don't really zoom out. And so I wanted to have Ben and Kevin on the podcast to do something different, which is share their presentation from the LP Summit. And the presentation is actually not about what's going to happen this year. It's not about what's going to happen next year. It is actually big predictions for the year 2030, right? Predictions for what is crypto going to look like, and really what is the world going to look like about 5 years from now. So Ben and Kevin are going to actually share their screen. So if you guys are listening on Apple or Spotify or wherever you listen to your podcast, I would recommend, we're going to drop a link in the show notes. I would recommend going to watch this on YouTube or Twitter. We can share a link on both of those because you'll get a lot more of the context. You'll be able to actually see the slides if you're watching on those places. So Ben and Kevin, I'm going to hand it over to you guys, and we can jump in.
Great. Thanks again, Jason. It's a pleasure to be here. Before we jump into these predictions, I'm just going to quickly go over a couple compliance disclaimers. So one is, these are predictions. They should be treated as such. All views expressed are subjective. There are opinions and belief. They're not legal, investment, or tax advice. ParaFi may be invested in some of the themes that we've discussed, and the views that we express here are our personal views. So just with that out of the way, we can now jump into it, and excited to run through really like where we see the future of crypto. And I think it's, to Jason, to your point, like people are very focused on the short term, the micro in crypto. So it's always great to just zoom out and level set on where we see the biggest themes, the biggest verticals, moving 5 years from now. So let's jump into it. We have 10 predictions. Kevin and I are going to volley back and forth. And please interrupt us with any questions.
Beautiful.
Okay, so let's jump into it. So we wanted to start with a Bitcoin price prediction and just really get it out of the way. So our first prediction is that Bitcoin will reach parity with gold by the year 2030. So if Bitcoin converges to gold parity, that implies a price of roughly 815K for Bitcoin on a fully diluted basis. And if you kind of think about what that implies in terms of growth rate, it's about 45 to 50% compounded annual growth in Bitcoin price for the next 5 years. And candidly, this is probably a conservative prediction because similar to the way that Uber didn't just get to the TAM of taxi markets, we think that Bitcoin will ultimately get many multiples of gold's market cap. So let's kind of like walk through our thought process on this prediction. And we think the best way to really think about Bitcoin and gold is really from a first principles perspective. So when you think about just the underlying traits of money, right? Divisibility, portability, ease of transactability, fungibility, we believe that Bitcoin is just a better first principles technology and skin for money than gold is. And look, gold has had a great run. It's for 5,000 years. Gold has been a decentralized form of value storage. It's compounded at 7 to 8% since Bretton Woods in 1971 when we went off the gold standard. But from first principles, we think Bitcoin is better than gold on everything, probably except for two things. So one is volatility. Bitcoin is still more volatile, and as well as operating history. Bitcoin's been around for 15 years. Gold's been around for 5,000 years. But most importantly, I think the single property that I think is most powerful with Bitcoin is that is its scarcity. So there's a hard capped supply of Bitcoin and there's not a hard capped supply of gold. When we then compare Bitcoin in this third column here to the dollar, I think one could argue the dollar is better as a medium of exchange across almost every property than Bitcoin is today. But the reality is, in our view, is that Bitcoin is not really competing with the dollar. You already have Venmo, which has doesn't have 10-minute block times. We have stable coins as an industry that are kind of wrapping dollars. But it is a much better Bitcoin is a much better, in our view, store of value. And this chart here is really kind of the crux of that point, which is supply side curves. So if you look at Bitcoin, currently 94% of all Bitcoin is in circulation. The remaining 6% will be released over the next 115 years. In the current halving cycle, the annualized inflation rate is roughly 0.9%. And you kind of compare that to the M2 money supply in the US, and it's grown 4.5x since 2000. So one of these supply side curves is concave, that's Bitcoin, and the other one is convex in terms of the US money supply. And so what I find to be like the most powerful property of Bitcoin is just that it has a completely perfectly inelastic supply curve. So it's one of the only commodities in the world where regardless of where price goes, you still get the same exact annual supply increase. And that doesn't hold for gold, that doesn't hold for oil, that doesn't hold for any commodity. And that, I think, that mathematical reliability is incredibly powerful. This kind of very much feeds into what's going on with the U.S. fiscal and monetary deficits. So this slide here shows the U.S. debt to GDP, the evolution of it over time. And today we're at 120% debt to GDP. Currently, the U.S. on its $36 trillion of federal debt pays $1.2 trillion a year in interest. And we'll see how effective Elon and Vivek are with their cost cutting initiatives. But I think the reality is that it will be very difficult just with our debt servicing costs for the US to run a surplus. And Bitcoin is the escape valve for that. And Bitcoin, and by the way, you show this chart, debt to GDP, for the vast majority of governments and countries globally, and it actually looks even uglier than this. From a supply side perspective, this is a chart here that shows Bitcoin's on-chain velocity, or kind of what people refer to as hodl waves. And the kind of key message here is that Bitcoin is there's a diminishing supply of Bitcoin that sits on exchanges globally, and that is in the free float. 34% of Bitcoin has moved within the past year, but the other 66% has not. And an increasing percentage of Bitcoin, 31% of Bitcoin has not moved in the past 5 years. So back in, okay, so how does this kind of tie into price? So why are we reaching this price prediction? Well, back in 2017, when I was at KKR, I put together this kind of sum of the parts valuation framework for Bitcoin. And I said, okay, let's look at store value markets. Let's look at medium of exchange. Let's look at kind of like financialization of assets. And I ran kind of like very back of the envelope math. And I got to a price of $450K to $1 million per Bitcoin. I think this analysis was in many ways like the wrong framework, or the framework has evolved, but the actual kind of price may end up kind of coming to fruition. So I wanted to rerun this analysis today, looking kind of strictly at Bitcoin as a store value asset. So this doesn't reflect, Bitcoin layer 2s or Bitcoin shared security or ordinals, runes, any kind of NFT activity. This is Bitcoin as a finished product, there's no technology risk. It's just Bitcoin, and it doesn't have to change. And if we say, okay, Bitcoin gets to gold parity, that's 815K. So that would reflect roughly 10x increase from today's prices. If you got to gold parity plus M2 parity, you're at roughly $1.8 million per Bitcoin. That's 21x upside from today's level. And then if you kind of want to dream the dream and look at kind of global M2 and believe that Bitcoin will start cannibalizing other non-dollar related currencies, you're looking at roughly $6.1 million per Bitcoin. And look, I think I'll kind of end this prediction with this chart, which is we're undergoing the biggest demographic shift that we've seen vis-a-vis wealth transfer. Inflation adjusted, the boomers in the US are passing 38 trillion of wealth to millennials and Gen Z over the next 20 years. And millennials and Gen Z, 2/3 of millennial and Gen Z prefer Bitcoin to gold. And about 33% prefer Bitcoin and crypto to stocks. And so this will be a multi-decade kind of secular demand tailwind that we think is going to inform and very much help our industry. So okay, that's prediction number one. And Kevin, I'll pass it to you for the next one.
Yeah, so for the second prediction, let's talk about stablecoins. And our prediction is that stablecoin supply will reach 10% of M2 money supply in the US. So let's see kind of where the numbers stand. So today, M2 stands around $21 trillion, which we kind of show in the dark green chart. And then stablecoin supply sits around $171 billion. And they've actually gone up a little bit since we plotted this. But what you can see is that basically these two supply charts have moved basically in tandem with one another for the past 4 to 6 years. And currently, the stablecoin supply is only 80 basis points of the total M2 money supply. So you basically need a 12x increase in stablecoin growth to reach our 10% prediction. So how are we going to get there? And by the way, one thing to note is that when ParaFi started, one of the first things that we kind of looked at was stablecoins. And stablecoins have been this relentless, both secular and macro trend in crypto, where whether it's through fintech adoption or macro adoption, they've continued to grow, which is some people kind of like went out and said, when interest rates rise in the traditional economy, people are going to dump stablecoins. They're not going to hold stablecoins because it can earn yield in the traditional economy. That has not happened. In fact, the contrary has happened. We've seen continued growth in stablecoin supply. So let's talk about the forces that are actually going to get us there. Let's start with the first one. So this key kind of like first force is stablecoins as new and as an evolution of the payment rails across the world, whether it's for global finance, whether it's for fintech or commerce. And to give you a few examples, in fact, there was one very recent one I want to call out, which is Tether financing 670,000 barrels of oil, roughly $45 million worth of oil between a very sophisticated commodity company and a very sophisticated trader. This is something that would typically be settled either in dollars or some other currency, but this time it actually settled with a stablecoin in a completely kind of commodity traditional market. And what that tells you is that market participants across global finance want to move money faster and settle it cheaper. In the traditional analog, this would have actually cost more money and taken a long time, and time is money. So now that people are being accustomed to seeing that stablecoins can move 24/7, 365, they're asking themselves, why can't I move the rest of my operations at that same speed? And by the way, we've actually asked a couple OTC desks in crypto what percentage of their OTC trades are settled in stablecoins. And depending on whether they're very crypto native or more TradFi, their answers have ranged anywhere between 3/4 of trades settled in stablecoins to about a third. So that's actually quite amazing that the major trades, when people are trading Bitcoin, ETH, etc., the majors are settling in stablecoins. The second thing is really fintech. So for the first, no, stay on the slide. So with fintech, what you're really seeing is that for the first time ever, you really have financial technology companies being able to build directly into a software native platform. So you're not integrating with legacy payment providers that have paywalls or are naturally talking about like different APIs. By running a full fintech stack solution on top of the blockchain, you have a composability across the whole financial stack. And that is very powerful because not only does it create a better user experience for people to do micropayments and transact quicker, but it actually creates a whole new business model for fintech companies where they're able to earn yield under underlying reserves that back those stablecoins. And that's something that you previously hadn't seen. And of course, you have like the normal things for like you want to pay for your coffee with stablecoins, and that slowly but surely is seeing more adoption from the major fintech providers, whether it's PayPal, Venmo, etc., to have this everyday transaction. So that's the first force, which is just an overall stablecoin evolution of payment rails. The second force is the store of value force. So this is not a store of value from fiat debasement. That's what Bitcoin's for, like Ben just talked about. But this is store of value against the inflationary pressures that have emerged across many emerging market currencies, and as a way to really protect the purchasing power of the USD. Like we complain as Americans that we have 120% debt to GDP ratio, but in most of the world, inflation is much more rampant than in the US. So the question is, what are those countries, those emerging countries, actually doing to protect their savings if they don't want to go out and buy Bitcoin, which could be volatile or so on? So they're buying stablecoins. This is a map of the world, and what you can see is a few hotspots on the left-hand chart. You see obviously the US being a top market, but if you kind of work your way down the map, you see Argentina and Brazil, which have suffered from inflation-ravaged economies for the past several years. And one anecdote, by the way, is that when we were trading stablecoins, we noticed that one of the regions, some of the exchanges that always had a premium to their stablecoin. So people know that stablecoins are worth $1, but they may not always trade at $1. What we saw is that there was a consistent premium in Brazil from people bidding willing to bid 5% plus above par to escape the inflation that they were experiencing in their local currencies. So, and of course, this is kind of, I like to say that like inflation ravaged economies are stablecoins' best friend because they're driving a massive global adoption of stablecoins. And I'm sure some of you that are on Twitter may have seen this right-hand side chart, which shows the activity of USDT to Tether on the Tron network in mapped to Nigeria time zone. And of course, Nigeria intersects other time zones. But what's particularly here is that, which actually when I kind of looked this up, I kind of struggled to believe it, but 60% of Tether's supply actually sits on the Tron network. That's like an astonishing amount. And like, we're talking about $60+ billion roughly of supply that sits on the Tron network. And the question is why? And when you kind of really dig into it, is because you have all these emerging economies that all they care about is super cheap transaction costs. And I mean like super cheap, like almost basically free. So it's no coincidence that you have a lot of emerging countries adopting payment rails through blockchains like Tron for their thing. So let's go to the next slide to talk about kind of like what's really the data behind these two forces. Since, well, what I would say is this: for our prediction to become true, we basically need a 50% CAGR over the next 6 years to reach 2.1 trillion. Okay, that would be 10% of M2. And if you were to ask anyone in another industry whether 50% CAGR is high, they would typically say it's, astronomical number. But in crypto, that's not necessarily the case. And let me tell you why. Since 2020, the stablecoin supply growth has actually grown at a CAGR of 115% year over year. So stablecoin growth has just grown 150% CAGR for the past 4 years. Stablecoin holders have grown at an even higher CAGR of 180. So you only need about less than half of that growth rate to get us to our prediction for the next 6 years. And what's really interesting, though, is that when you look at the number of people that hold crypto, which is around 560 million, so around 7% of the world population hold crypto. Stablecoin holders are only around 2% of the global population. So 120 million versus 560 million. When we looked at the average balance of the stablecoin holders, it's around $10. That's the average value of stablecoins in people's accounts. So if everyone that holds crypto would hold, if everyone that holds crypto would hold stablecoins, you would actually have a much higher number of stablecoin holders, and then you would actually only need half the amount of. You would only need around $5 to reach our supply, because $5 times 560 would put you above 2.1 trillion. So it's actually not that out of kind of like, it's not that out of reach, and for that reason, we actually think that stable coins are not just gonna meet the 10% of M2. We actually think they're gonna blow past it, potentially settling around 20 to 25% of M2.
Okay, so the third prediction.
Hey Ben, before moving on to that, Kevin, I've got like one or two questions for you on the stablecoins. So right now, Tether, I think there's roughly like 170 or 180 billion dollar total supply of stablecoins. Tether is roughly like, I'm gonna maybe botch these numbers a little bit, but Tether's roughly 130 billion of that. USDC is roughly 35 to 40 billion of that, and then there's a few small other ones. So one question is on like what this makeup will look like, USDC versus Tether versus maybe something else, and then the other question is, ETH makes up about 50% of the stablecoin settlement. Tron is roughly the other 40 to 50%, and then like Solana, Binance Smart Chain are like a couple percentages each. What are your thoughts on USDC versus Tether, and then ETH versus Tron versus other settlement networks?
Yeah, stablecoins have gone through a very interesting journey. When we started paying attention to stablecoins back in 2018, there was Tether, there was USDC, which was very, very small back then, and there was obviously DAI. DAI being this like crypto collateralized MakerDAO stablecoin. And we kind of started from like that small cohort of, let's say, like a handful of stable coins. We went into the 2020, 2021 DeFi summer. You saw this massive explosion of the number of stable coins that kind of came to market. Algorithmic stable coins, crypto collateralized stable coins, fiat backed stable coins, some cases Euro stable coins, and then everything kind of came crashing down after the Terra Luna collapse and the FTX collapse. So we saw a handful of stable coins grow to dozens of stable coins, and we're back down to like a couple of stable coins. And in my opinion, what the market tells you is two things. One is that is that first of all, the market has clearly placed very strong emphasis on resilience of stablecoins. So people don't necessarily want to be holding a stablecoin that has low float, low supply, and maybe like it's banked kind of like in some shady way because it doesn't inspire trust that you kind of need for the adoption and things. And Tether suffered for this for a long time, where there was a lot of speculation whether they were insolvent or not solvent. But over the years, as you've seen those rumors kind of be put to rest, you continue to see Tether stablecoin supply growth. So it's very, very difficult, in my opinion, nowadays for a completely kind of like de novo stablecoin to be able to outpace the stablecoin supply growth that you've seen in USDC and Tether. It doesn't mean that it can't happen, but it certainly can't just be another dollar stablecoin. We saw, for example, with the Gemini dollar, they had a New York the Financial Department of Services regulated stablecoin that has struggled to grow despite having every rail to succeed. And the reason is because at the end of the day, people have not necessarily seen the need to adopt stablecoins that they can't have the same liquidity like in other rails. Like if I'm holding GUSD and I call an OTC desk and say, hey, can you settle a Bitcoin trade on this? They may say, hey, no, I only care about settling in Tether or USDC. So it's a classic saying of liquidity begets liquidity when it comes to stablecoins, and for that reason, I think we're going to the odds that we have fewer stablecoins versus a large number of stablecoins, I think is much higher that we have just a handful of them versus more.
Nice.
Yeah, like just to add to Kevin, look, like I think there's an incredible amount of path dependency in crypto. If the world started from scratch today, like I don't think Tether would be the largest stablecoin, but that doesn't matter, right? Like the best designed product doesn't necessarily win. So on like one end of the spectrum, like we have a stablecoin monopoly, and on the other end of the spectrum, we have like this heterogeneous, like fragmented stablecoin world. I think we end up much closer to the monopolistic world. Like today, it's basically a duopolistic environment. And for that reason, I'm personally kind of fairly bearish on PYUSD or some of the competitors, and they have not gained meaningful traction. So I would echo kind of what Kevin said. This is a network effects technology and product. So
yeah, the big question, and we've looked at stablecoins a lot. Like, what do you gain by holding another stablecoin? And the answer is like really not much. Like they kind of function similarly. They're integrated to the similar platforms. But even when you kind of do a look through of where they're custodied, like the actual dollars backing those, there is fairly high concentration in like a handful of banks. And people kind of got the wake up call when Signature and Silvergate kind of blew up, where people were like, oh, all this stablecoin concentration is actually in a couple of banks, and even though you would have expected that to spark more diversification for stablecoins, it didn't really. It helped Tether significantly, by the way. Like in the day that Signature was blowing up, the spread between Tether and USDC was like 20%. Okay, like people were just bidding Tether, this proverbial stablecoin that was going to always blow up, and the safest current stablecoin USDC was trading at like a 10% discount. So you kind of have seen this risk appetite to just be concentrated in a couple stablecoins versus being diversified, because it doesn't offer much at the end of the day.
Cool. All right, let's go on to number 3. Thanks, guys.
Okay, so prediction number 3. Our third prediction is that tokenized real-world assets will exceed the value of all digital assets. So this is another way of saying that things other than stablecoins, so tokenized stocks, bonds, currencies, commodities, will exceed crypto market cap as we view it today when we add up Bitcoin, ETH, and altcoins. Okay, so I like to kind of like ground this prediction in the why. Like, why are tokenized real-world assets relevant? And you really have to understand our financial system and how it's evolved. So this is one of my favorite charts. It shows financial services as a percentage of global GDP. And post-World War II, financial services as an industry was 1.5% of global GDP. Today, financial services is 5% of GDP. So what kind of this chart says is that in real terms, in inflation-adjusted terms, the financial services industry has grown 3x. It's effectively, its aggregate profits are 3x higher. And I think this matters because like finance as an industry is not a productive industry. It's just meant to provide, to be a lubricant to other industries, to move money, to have open capital markets, and so on. And so this chart implies that the financial services sector is extracting meaningfully more rent. And notwithstanding this chart, like I don't think anyone feels that finance has gotten 3x better, right? We still don't have an Amazon-like experience for finance. Despite all the innovation on the internet, I can order Uber Eats, it shows up at my door, food shows up at my door, 15 minutes later. It's still very difficult to send money, receive money, get a mortgage, pay your taxes, send money back home. The financial services system does not work very well. And the other thing we've observed here is just entropy. So think about the past 5 years in finance. You've had 2 of the 3 largest bank failures in US history. You've had platform blowups like what you saw with nickel trading getting halted on the LME, or Robinhood restricting trading in GameStop. You've had single dark pool trades like with Archegos kind of send ripples through the financial system. The financial markets today are chaotic and opaque. And I think we can agree they don't really function or work very well. And certainly, they only serve a very small percentage of the global population. There has been a lot of innovation in fintech, and we're big investors in fintech. But the reality is most fintech companies are not 0 to 1 innovation. They're creating a glossy kind of digital front end on top of the same opaque, slow, back end that we've been using for the past 50 years in Swift. So the question is, and really the answer to this in our view is this idea of kind of tokenizing real world assets and moving them off Swift, off DTCC to a whole new set of rails. And we've seen over the past year this concept, which we've seen with stablecoins as a starting point, move and spill over into the broader asset stack. So just in the past year, we've seen tokenized real world assets. This chart's a bit stale at this point. They've almost doubled year to date. We're almost at 15 billion of tokenized real world assets. So our mental model and framework for why an asset should be tokenized comes down to several points. It's the transferability. One, when you have an tokenized asset, you have atomic settlement, so you don't have T+2, or in the case of some assets, T+30. You have sovereignty, so you can hold assets directly instead of through intermediaries or broker dealers or custodians. You have efficiency and auditability, so all the fund administration functions can get streamlined. And actually, ParaFi, we're kind of eating our own dog food in the sense that we've tokenized a sleeve of our latest venture fund to really appreciate and use the value of this technology. But you also have like kind of the micropayments that are enabled here that you just don't have in kind of the traditional system. You have composability. So all these assets now being on a kind of uniform shared ledger can all speak to one another. And it's not just financial assets, but it's the title to your vehicle. It's the mortgage on your home. Can be airline points. It can be your university diploma, like things that we don't traditionally think about as assets can get tokenized. So them all being on the same ledger is incredibly powerful. And then there's kind of the programmability of these assets. So we think about, we call kind of PDFs dumb contracts, and then what you have on Ethereum are smart contracts. So many of the world's assets are just encoded in PDFs. And the beauty of tokenization is that when you have assets on a blockchain, you can program logic into the actual asset itself. This reduces the need for lawyers, for administrators, for trustees, and it also opens up a whole host of other, AI agent use cases where micropayments can be enabled. So, we could talk about this slide for, an hour, but I think that the crux of it is this just makes more sense, and now the data is starting to follow. And here, you can see like it's BlackRock, Franklin Templeton, the California DMV, Hamilton Lane, KKR. Everyone is starting to really embrace and use this technology. And we look at Larry Fink at BlackRock as kind of like a great example of kind of waking up to this. So here are a couple. Back in 2017, he said that Bitcoin was an index of money laundering, and he didn't really get past Bitcoin in his analysis of the digital asset space. He kind of started and stopped there. But today, he kind of calls himself a proud skeptic, and now he comes away saying that this is the most important technology for capital markets since we moved from analog to electronic in the 1970s and 80s. So now, BlackRock has the largest Bitcoin spot ETF, the largest Ethereum spot ETF, the largest tokenized treasury ETF. They're investors in Securitize. This has all happened in the past year. And so now you're just seeing this groundswell of activity in the financial services space. You've also seen it kind of in the long tail of assets. So, tokenized Pokemon cards, tokenized luxury watches, tokenized YouTube royalty streams for creators. You're seeing kind of the longer tail of assets that don't have traditional capital markets coverage start to move on chain. And there's quite a bit of traction here, where I actually think similar to the way that China kind of went straight to mobile payments and leapfrog kind of the legacy payment infrastructure, you're going to see a lot of these long tail assets just move on chain. They're never going to be supported by the banks and traditional capital markets. They'll move right on chain. And what we're looking for, because this is a network effects technology, is which of these subcategories are going to get to that critical penetration rate where if you want to participate in the asset class, you need to be on chain by default. Like if you want to participate, well, you have to own these assets in a tokenized format. So, our view here is like, and this is a chart we often reference, which is, when will this play out, right? Because people have been talking about tokenization since the 2017 ICO era, where people were tokenizing dorms in Charleston, South Carolina. And there was all those projects kind of ultimately failed. There wasn't liquidity. So the big question is when. And this is a chart that shows different technology adoption curves in society over the past kind of century. And there are kind of two big takeaways here. So the first is that today technologies are being adopted more quickly than ever before. So kind of the slope of the curve is much steeper. And the second takeaway is that technologies that didn't require hardware rollouts, that just are kind of software based, can get adopted much more quickly by society. So if you look at electricity or the automobile, those took a while because they're constrained by the laws of physics and physical materials. Whereas if you look at social media, that was adopted much more rapidly. So we kind of think we're at the point of kind of takeoff in the real world asset tokenization world, and we're going to see a lot of meaningful growth over the rest of this decade.
Nice. Thanks, Ben.
Well, should we jump into number 4?
Yeah, I've been waiting for this one. Prediction markets.
Okay, this one is exciting. So this prediction markets, we believe are going to disrupt traditional media and become the first mainstream consumer application on blockchains. In some ways, this prediction's already played out with what we've seen over the past month, but I think prediction markets are going to grow meaningfully every year for the rest of the decade. It's not just a once every 4-year phenomenon. Okay, so let's just kind of level set. I think most people know what prediction markets are, but or have heard of them this year. But Polymarket was the #1 app in the iOS store in news, ahead of CNN, ahead of New York Times. It was one of the top apps in the world. I think it hit #1 in the entire iOS app store on election day. It had over 30 million visitors to its front end, polymarket.com, in the month of October, which is about 80% of Coinbase.com's website traffic. It's been discussed and referenced in the Wall Street Journal and the New York Times, tweeted about by Elon, retweeted by Trump. It's kind of hit this mainstream hysteria. And one of the fascinating things, like when I talk to my friends outside of crypto, is many reference Polymarket and just have no idea that it's a crypto product. Because actually, for some people think about Polymarket as like a trading application and betting application. But the vast majority of people think about Polymarket as actually just a news source. So that's very exciting. I think when we think about these prediction markets, and just very high level, these are markets that resolve to 0 or 1 based on whether an event occurs. They can be very, very valuable sources of information. Back before people were focused on Polymarket and prediction markets, we were looking at this market that we're showing here, the odds of Biden dropping out of the presidential election. And this was pre the debate with Trump that didn't go well. This was back in late 2023, early 2024. The market on Polymarket was pricing Biden at a 20 to 30% probability to drop out of the race. And this was at a time when he was the presumptive candidate. The Democrats weren't running kind of an open market primary. And so this just kind of shows that, the market was kind of more accurately discounting the probability of him dropping out. Then what happened is during the debate, this market started to move in real time. And what was fascinating here is this was a direct referendum during the debate on who was winning the debate. And so instead of listening to kind of the talking heads on CNN pontificate about who won, who lost, or on Fox pontificate about who won, who lost, you can just reference markets, and they're a higher fidelity, in my opinion, source of truth relative to what any single expert says, because there's actual money on the line. Another great use case for these prediction markets is the latency of information. So we go back to kind of the July 13th Trump assassination attempt. This is a chart where we show a time series of Trump's odds to win the Republican nomination. And it was trading at 99.5 cents. So it was, because he was, he had effectively won. He was the presumptive candidate. Shots were fired at the Trump rally at 6:11 p.m. Eastern time on July 13th. Before any meaningful account on X tweeted about what was going on, Polymarket moved. Before any mainstream media outlet tweeted about it or was covering it, Polymarket immediately moved. And you can see here the market corrected down to roughly 97 cents on the dollar. Over the next, call it hour, the media outlets started to report on it. People were talking about it on Twitter, but Polymarket adjusted before all of those sources. The other really interesting thing here is during a period of time where people did not know, would Trump be okay? What was his would he still be the candidate? Was he dead? No one really knew. And Polymarket provided very valuable information that, in fact, he appeared to be okay. It never dipped below 97%. And then the last chart here, we show Trump's versus Kamala's odds to win the election during election day itself. And what you can see here is like throughout the actual election day when the polls were open, the odds didn't really move. But then as the polls started to close, as major news networks started to cover the results of the election, Polymarket odds adjusted well before the mainstream media outlets. I think that's a function of the mainstream media outlets want to drive ratings, may want to make the race seem closer than it actually is. So Trump was already trading at 96, 97 cents, by midnight when the race still wasn't called. So again, very valuable high fidelity information. And look, volume has exploded this year. And we've seen $3 billion of volume on Polymarket over the last month. We've seen roughly 300,000 active wallets on the platform. And notably, these numbers are not materially off in the post-election period. They're off slightly, but not materially. This technology of prediction markets isn't just about politics. It extends to sports. It extends to science. It extends to, culture markets. There are markets on whether different venture-backed companies will still be in business over a certain period of time. So you can think about this as almost like an insurance marketplace. And one of the fascinating things here, just to close out this prediction, is that we actually think that AI agents are going to be the largest participants on Polymarket over the next couple of years. Because if you have, as an example, a weather market, how much will the Earth's temperature warm in 2025? No one can really compete with an AI agent that's reading meteorology publications, taking in alternative data from weather APIs globally, and using its natural language processing ability to make markets in real time on Polymarket. So I think AI will compete with AI to make very accurate markets on Polymarket, and that will be a very valuable source of information for humanity that we can use. So this is very exciting for us, and just full disclosure, ParaFi is we're the largest investor in Polymarket, but we've been invested since 2020. But we're huge believers in this category.
Ben, how do you think about maybe two-part question here? Robinhood recently launched Polymarket prediction markets. There's Kalshi. I've probably seen more pitches this year for new prediction markets than any other application in crypto. So I'm curious how you think about that. I'm also curious how you think about the relationship between media and prediction markets. Right now, they seem very antagonistic towards each other. Shane is tweeting we are the new media. I've always seen it, and I've talked to Shane about this, less one versus the other. It's more I think they can be very symbiotic towards each other. But I'm super biased as a media operator here. So I'm curious how you think about those two questions.
Yeah. So on the first question, I think that decentralized prediction markets have a very tangible advantage over centralized prediction markets like Kalshi because they're global. They're 24/7. All the betting activity on them is transparent, so you can see, exactly what wallet behavior looks like. And actually, one of the observations we have is there were actually more wallets that owned Kamala shares, but they were smaller size, fewer but larger wallets that had bet on Trump. You can see the cost basis of every participant. Again, they're 24/7. They're global. Kalshi's, you can only deposit money on Kalshi during the 35 hours a week that banks are open, right? So they're kind of constrained by banking rails in a sense, right? So I just don't think there's any competition at the end of the day when all is said and done. I think that these will be, decentralized prediction markets will end up being much, much bigger. I think the disadvantage is obviously kind of blockchains are still difficult to use. You have to bridge assets to Polygon. The UX is not super intuitive. So there is a bit of a trade-off. But look, like Polymarket's volume was 20x Kalshi's over the past month. So we'll see how that evolves. Yeah. But I'm kind of, I believe this is like a use case that just makes a ton of sense on chain versus off chain. And then on your second question, look, I think that like media will start, referencing and embracing kind of the data from Polymarket and incorporating it into their stories and analysis. Bloomberg is now, you can access Polymarket data on a Bloomberg terminal. I think Polymarket will get the Polymarket data and probability will get discussed and debated more on air. But I think there is a bit of like an innovator's dilemma here. So, whereas like previously the media was thought of as the source of truth, this is a direct threat to, that kind of position and credibility. And so, I think it's going to be interesting to see how that evolves over time. Maybe the whole fundamental nature of what media and news may evolve and change.
Yeah, I'll add a couple of things, which is throughout this whole election cycle, people, prediction markets like Polymarket are actually fairly novel. People say, "Oh, I used to use prediction markets for the last election, the 2016 election," but those are just incorrect statements because they failed to understand that when they were using those like trading sites, those odds were set by bookies, by centralized bookies, like small number of participants that were deciding the likelihood or probability of something. Prediction markets are competitive. They're global, and information is priced much better. And Vitalik actually published this article not too long ago, earlier this month, that he's kind of creating this category as like a derivative of prediction markets called info finance. And this idea that you're going to see all these novel markets, but not about what prices do, like a typical financial market, but about the likelihood of certain events, whether it's government, politics, science, you name it, like, weather, et cetera. And that was going to become like a whole new asset class for what's called info finance, that are proxies, financial instruments that are proxies to conveying information from a news standpoint. The second thing that I would say is throughout this whole cycle, I mean, you saw there was just constant demonizing from like traditional media against like prediction markets. Oh, prediction markets are manipulated. They are skewing the odds in Trump's favor. They're skewing the odds in Canellis' favor. And there was this whole misunderstanding about what a prediction market is. And ultimately, a prediction market is just a market. If you believe that prediction markets are efficient and that they are globally accessible, that people have the ability to express and price information in real time, then logically you have to kind of have the view that these markets are efficient at pricing that information. If Polymarket was segregated and only accessible to like a very small number of participants in a specific region in the world, maybe you could say, hey, that they're actually not very efficient because they have biases, or they're not competitive, or like the skews are off. But what was really interesting is that when you saw Kalshi launch and IBKR Forecast Trader launch and Robinhood launch, and all of a sudden, all these markets that had different populations and different customer segments were all pricing very similar odds. You kind of got rid of that excuse of like Polymarket cannot be possibly manipulated if every other market is showing very similar odds. And people were like, oh, well, there's like a 2% spread. And sometimes there was like a technical nuance on like how easy it was to get money in, or the exact description of the contract, whether one was expiring on November 5th or on inauguration. So I second Ben's views. I think these markets are going to be absolutely massive. the biggest barrier, in my opinion, and we've looked into this a lot because I think there's a lot of actually amazing opportunities from an alpha generation standpoint, is how easy is it to move money into these markets? I think Polymarket, despite being the most liquid and have the best liquidity and most volume, it's still, for the average user, incredibly difficult to use. So I'm excited to kind of see how those UXs become even more invisible to use, because one very interesting thing is Polymarket was the number one news app, but Kalshi was like top 10 finance app. And the question is like, why was one a news and why was the other not? What was the other finance? Is because you couldn't actually trade through Polymarket's app. Okay, and put aside the fact that there's US people that are restricted from trading, just a normal user with an iPhone couldn't actually trade through the Polymarket app because the UX was not quite integrated. So I'm actually very excited to get to the point where you are able to trade and fund Polymarket just in the same way that you would fund Kalshi or Robinhood or Interactive Brokers.
Skale is the blockchain that is simply built different. Let's face it, other L1 networks have costly transaction fees that increase as the network gets busier. Skale has solved this problem with a gas-free, scalable infrastructure where users never pay gas fees. Skale was awarded the most active gaming chain in 2023 by CoinGecko and hosts 5 of the top 25 games on DApp Radar. You should definitely check out Skale. I was using it the other day. It really is incredible to use. That's Skale, spelled with a K. Hit the link in the show notes or head on over to skale.space/ecosystem to get started today. Hey everyone, Jason here. I wanted to take a second to break down why Magic Eden's getting into token trading. Their team is extremely concerned that crypto is still consolidated in the hands of a few centralized exchanges who act as gatekeepers, ultimately recreating the TradFi space. They believe that crypto is still missing an on-chain Binance, and their aim is to move trading completely on-chain, fully decentralized. They've done $6 billion in NFT volume in the last 3 years and have had more than 1.4 million users visit their platform in the past year, making them the #1 NFT platform in the market today. They are the ones that can do it. Stay up to date with Magic Eden's journey by giving them a follow on X at Magic Eden. Uniswap Wallet is designed to easily manage, store, and swap your crypto all in one place. Access thousands of tokens across Ethereum and 10 plus chains, including Base, Arbitrum, Optimism, and more. Uniswap's wallet has built-in MEV protection and 0 gas fees with swaps that go through Uniswap X. You can also swap with the peace of mind that the code is completely open source and independently audited. Download it today. It's available on Chrome, iOS, and Android. Hey everyone, Jason here. Wanted to just take a quick break and highlight everything that's been going on in the Mantle ecosystem. In just 1 year, Mantle has seen its TVL surge by over 1,100%, now reaching $1.69 billion. That's just such a crazy amount to think about. More than 225 protocols have made Mantle their home, while the platform's Eco Fund has invested $38.5 million in 51 pioneering projects. Through strategic partnerships with Bybit, including MNT as collateral, supporting Athena to scale, and the first Ethereum L2 to integrate Ondo Finance, they just continue to be on the bleeding edge of L2s. Be sure to stay up to date with what's going on by giving them a follow on X at 0xmantle. Special thanks to the incredible Mantle team for sponsoring today's episode. Earlier in today's episode, I mentioned Ledger's latest products, the Stacks and Flex, and I wanted to take a few seconds to tell you more about them. For Black Friday only, Ledger is offering $70 in Bitcoin if you upgrade to the Ledger Flex. You can also save up to 40% on selected Ledger Nano wallets and accessories. These wallets are virtually impenetrable to online attacks because they store your private key in a secure offline chip. You can manage more than 5,500 tokens and install up to 100 apps. Offer is only valid until December 5th or while supplies last, so be sure to hit the link in the description of today's episode so you don't miss out on this really good deal. Okay, let's wrap on prediction markets. Ben and Kevin, take us into prediction number 5.
Prediction number 5 is all about AI, and it's our prediction is that AI will comprise 90% of on-chain activity by dollar value by 2030. So let's kind of like frame that for a second. ChatGPT launched its kind of like novel model LLM in late 2022. Since then, we've really kind of been witnessing one of like the greatest technological and economic transformations of our time through AI. And as of this month, for example, if you're like a iPhone user, you now have Apple Intelligence in your pocket, and by the way, that's going to integrate with ChatGPT. So it's really kind of like expanding the reach of this type of LLM tools and chatbots to most people. And like I think the average person doesn't really know what even a chatbot is. They've heard about it, but very few people are power users of it. So let's talk about really how crypto is playing a role in the AI revolution. The first thing is infrastructure, and I'll talk this in a second. Like the first thing is infrastructure, which is Bitcoin miners are really kind of beginning to repurpose their energy and power data centers for AI capacity and training. You're seeing that across a number of big publicly traded Bitcoin miners. But the thing that I really want to talk about in this section is AI on chain. And I'm talking about AI systems like large language model that are integrating directly with blockchains. And just to clarify something, I'm not talking about training AIs on chain. I think we saw that in like 2019, 2020 of like the decentralized AI or things like that. Like this is not our thesis. Our thesis is simply that we're going to see an increasing amount of this intelligent agents active on across blockchains and consuming a majority of the block space. And why do we think so? So the first thing that I want to clarify is this distinction between bots and AI agents. Obviously, we know there's bots in crypto. We've known them, from many years ago. Like it's not unusual to see a liquidator bot or a trading bot or some other bot doing things on chain. But the main difference between a bot and an AI agent, as we're framing this prediction, is a bot is just a piece of software logic, of business logic. It has classic if-then conditional logic, is deterministic, and it kind of does things like a traditional program. An AI agent obviously has some business logic because it needs to know what it's doing, but at its core, at its nucleus, we have an LLM. And this LLM is able to understand and interpret the language of smart contracts. And one breakthrough that it's particularly interesting of LLMs is that they were actually made to interpret written language. They're not like they're tokenizing words, and loosely typed languages like Python are actually great methods for them to write code. So you've actually seen chatbots have amazing abilities for code writing because they're tokenizing the language. So the key breakthrough here is that you now have this compute substrate where AI can integrate directly with this substrate that's blockchain for computing, and it can do many things. So you're not dealing with you're not dealing with down websites or authentication pages like you typically would run into in the traditional Web 2 world. Like if you're building a chatbot in Web 2 world and you try to do an action, you're going to run into paywalls, you're going to run into authentication processes, you're going to run into like servers that maybe don't integrate with your software drivers in the way that you want to, and so on and so forth. In crypto, that's not really the case. It's a permissionless and global compute substrate. So these agents are really kind of like meant to run wild. And if you've been following Twitter, I'm sure some of you have seen like this truth terminal type of like, sophisticated bot agent. And again, query whether that's actually a person or an AI, but you've seen this kind of experiments that you have this AI agents kind of just running wild, doing financial experiments that are, beyond people's imagination. So let's talk about kind of concretely what's happening on AI coming on chain. There are three kind of things. The first is that you've seen examples of AIs paying other AIs with crypto. You're having, for example, VanEck say that crypto AI revenue by 2030 is actually going to exceed $10 billion in annual revenue from on chain. And one of my favorite ones is actually Bernstein saying that digital asset micropayments, like traditional digital asset micropayment, are going to unlock AI adoption. And then, like, when I first read this, I was like, what's the connection between digital asset micropayments and AI? But then it comes back to the topic of you actually cannot have high frequency micropayments unless you have systematic ways of doing that through AI. And you can't necessarily do that in the traditional finance world if you're having the limitations that I described. But in the crypto world, you actually are able to unleash the AIs and able to process a very high throughput of micro financial transactions without getting paywalled. And I ultimately think that you're having the AI agents are going to drive the next wave of crypto adoption, and they're really the perfect medium, because it goes back to the question that I was mentioning. Like, the average person finds crypto the UX of crypto very difficult to use, and AIs have the perfect opportunity to simplify that, because it no longer is about you or a friend trying to navigate smart contracts and sign transactions. You're now interacting with a friendly chatbot that can assist you with those transactions. So the next slide really kind of talks about this developments, this software development kits that we're seeing launched by the Coinbases of the world, by Polymarkets. And by the way, this is just a couple of examples. There is many dozens of this that you're seeing in the space, where you're having SDKs particularly tailored for LLM adoption, because these companies are realizing the big opportunity. So imagine that I could just prompt we were chatting about prediction markets, right? So imagine that I could just prompt my chatbot and say, I want to bet 10,000 USDC on Polymarket that the Federal Reserve will cut rates by a quarter point by year end. And rather than me figuring out how to take money from my Coinbase account into a smart contract and bridge it to Polygon and then to deposit to Polymarket, the LLM, because it can interpret the smart contracts, would just compile a list of operations, present it to me in a human readable format, and I would say, yeah, proceed, this looks good. And then it would go ahead and do all the operations behind the scenes and then bet on Polymarket. So these are intent-based actions versus having to actually deal with the smart contracts ourselves. And I actually believe that this UX, the AIs will actually radically change the UX of crypto, and it will actually has the potential to onboard the next 10, 20 million users into crypto because of that.
Nice. Great.
All right, let's keep things moving. So prediction number 6. We believe that the most lucrative investments in the upcoming cycle will be at the application layer rather than at the infrastructure layer. And just as kind of a sub prediction, we expect to see over 20 different applications that generate 250 million plus of ARR and 100 million plus of free cash flow. So let me just kind of contextualize this for a second. So most people come into the space in crypto, most institutions, almost all of them enter in through either Bitcoin or maybe stablecoins and RWAs at this point. And when you kind of look and try to value Bitcoin in particular, it's a bit of an esoteric exercise. You kind of price it relative to gold. And you kind of lose many fundamental investors. I think what a lot of people miss is that the application layer in crypto is not difficult to value. Most of these applications, either collect fees or have the potential to collect fees, and you can run kind of discounted cash flow analysis or look at PE ratios on these projects and actually value them. Look, there has been like a surplus of investment into infrastructure over the last, call it 3 to 4 years. The vast majority of venture capital has gone into infrastructure, bridges, MEV, wallet as a service, all these, shared security, all these kind of things that are beneath the surface that the reality is don't really connect to the average consumer or person. We think that it's very much time for the application layer to see more investment and to see more growth. I mean, it's already happening. And I think it's just going to only accelerate for the rest of this decade. I think the application layer in particular is poised to capture a lot of value because these are software plus 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 business models. So, they're very, very high incremental margins, sometimes 100% kind of flow through to EBITDA or free cash flow. These businesses can be launched in a very capital efficient format. One of the most commonly cited examples of this is Uniswap, which effectively grew to $1 trillion plus of on-chain volume with only $11 million of venture capital. And the product was launched with a team of less than 20 people. So these are very, very capital efficient from a both financial capital and human capital standpoint to launch. And you have kind of global accessibility from day one. So if you like the business model of software, which I think most people do, you're gonna love the business model of crypto applications. I think they're some of the most powerful in the world in terms of the speed that they can scale and the return on invested capital. What we've done on this slide is attempt to kind of apply a PEG ratio to some of the most well-known projects on the application layer, a PEG ratio being kind of a PE ratio over kind of growth rate. And what you can see here is, there are a number of very cash flow generative and high revenue producing applications in the space, which is impressive, but these are also all growing at a very fast rate. And if we were to, superimpose kind of other large public SaaS companies onto this slide, crypto would look like materially better. A great example of top earning application in the space is MakerDAO, which is now Sky. And what we've shown here is you can look at something that looks and feels like a GAAP financial statement, an income statement, or a free cash flow statement, and in real time. So you can look at it on a periodic basis, either weekly, monthly, annually, quarterly, or you can look at it in real time, and you can apply that same kind of underlying bottoms-up fundamental analysis that you would if you're looking at any public company, but apply that same kind of framework to looking at tokens on the application layer. And look, we all know that the market can stay irrational and people may want to buy meme coins, but I'm a believer that over time, over the arc of time, markets converge towards fundamentals. It may take time, but if there are two projects and one is definitively more earnings on chain than the other, it should be valued at a higher valuation as time goes on. So this to me is very powerful. And the last thing I'll say here is I think that one of the things, just from a regulatory standpoint, we may see in this coming cycle, and you kind of saw last week, is a number of projects that have made the decision to not collect fees and turn on fee switches. We may see fee switches now come on in this cycle with greater regulatory clarity. I think a lot of those fees may go to buyback and burn programs, which I think will be a direct catalyst for many of these tokens. So I think that has been a very material change in the last week. If we're talking 6 months or a year ago, maybe the thesis around the application layer wouldn't be what it is today.
Ben, do you think these are, does the value end up accruing to the DeFi applications or more like consumer I'd call Polymarket more of a consumer application, where I know you guys are, I think you said the biggest investor, or I don't know, concert tickets on the blockchain, or that kind of stuff. Where do you actually, what kind of applications?
I mean, it's tough to say. I think that there'll be value that accrues to a number of different on-chain categories. I mean, finance, I think, has the most product market fit and is the most intuitive in terms of how you can extract value. If it's a lending and borrowing marketplace, you can take a cut of the interest paid by borrowers to lenders. If it's a trading marketplace, you take a cut of volume. Whereas in the consumer side, maybe it's a little bit less intuitive how you extract value, although I think there are typically kind of clear ways to do it. But I think it will be diverse in terms of that value accrual. Okay, let's go on to prediction number 7.
Oh, I love this one. I'm excited about this one. Yeah.
All right, so our 7th prediction is that wallets are going to become some of the most valuable business models in crypto, and really will evolve to kind of become thought of as the same way we think of banks today, kind of as diversified financial services hubs or platforms. So there are a lot of, we think there are a lot of good business models in crypto, but I think few can kind of compete with wallets. So it centers around kind of one, growth in the space. So if you look here at the average monthly unique active addresses on chain, we're at roughly 40 million on-chain addresses in a given month today across all blockchains. This has grown every year for the past 6 years, and it's grown at about a 55% CAGR. Whether you're if you're interacting with any on-chain application, you need a wallet, and that wallet could be known to you. It could be something like MetaMask, or it could be a wallet as a service platform, and it could be abstracted away. But either way, you need kind of that private public key pair that we kind of call a wallet today. So kind of why do we think that wallets are such valuable businesses? Well, it kind of comes back to what we kind of call like aggregation theory. So there's a great blog, Ben Thompson, Stratechery, where he talks about why businesses like Facebook and Google have become so valuable and become so dominant. And kind of the crux of that thesis is that they own the user relationship. So they sit at this very critical point in the supply chain between consumers and businesses, and they kind of control where attention goes. And I think the same could be said about wallets. So they're this wedge between kind of the user and this ocean of different applications. And candidly, like we know this firsthand, large investors in Consensus, which operates MetaMask, it's a very strategic asset in the space. Every team wants to get in front of MetaMask to form some sort of relationship. So I think many people think about these wallets as like, custodians. That's all a wallet is. It's just a crypto kind of custody account. But really, like if you think about what a wallet is, it's kind of your on-chain passport, your identity, your access key, your credentials, your money, your identity, all kind of rolled up into one. And I think, our view is what we've seen in the wallet space, I think over even the past year has been pretty incredible. Things like account abstraction, gasless transactions, using passkeys for login authentication. All these things are making the UX materially better. And it's also possible that we kind of do away with the word wallet altogether. Maybe it's called something entirely different. So a few examples of this in our portfolio, and I'll run through these quickly. So one is Gnosis Safe. So Gnosis Safe custodies today about 2.5% to 3% of all crypto. And you can see here 6 million safes have been created cumulatively since inception. This is kind of the go-to wallet for most DAOs or foundations because these are multi-sig, and if one key is compromised, transactions can still be executed by the remainder of a quorum. And what's great about Gnosis Pay is they make things like token vesting simple, payroll automated, and you could also program in conditional transfers to these underlying tokens. So it's just a very useful product, and it's becoming more useful. A second kind of example is Fireblocks. So Fireblocks is like what Safe is, but for enterprise. So you have compliance, dedicated account managers, and Fireblocks is dedicated is kind of integrated into all the major exchanges and payment gateways. And one of the super impressive things about Fireblocks, and we've blurred out the numbers here to protect the confidentiality, but this is a business that just like grew through the cycle. Like you almost can't see FTX on this chart. Like they just are, they're printing, they're growing their user base. They're onboarding large banks and institutions. They have very strong network effects. And I think Fireblocks will end up being, one of the most valuable companies in the space, and what we believe to be kind of a best-in-class enterprise software company. And then the third and last example is MetaMask. So I think many of these wallets, initially just monetized through kind of like transaction activity or swaps. They took a cut of that volume. But one of the fascinating things with wallets is there's so many different ways to monetize. You can monetize the fiat on-ramps or off-ramps. You can monetize and take a cut of staking rewards. You can create kind of social recovery features. You can put in place ways to mitigate kind of MEV. So the wallet is almost like the beachhead. And once you own that customer relationship, there are lots of ways to add value to your customers over time, but also, take some cut of activity from your user base.
By the way, just something to note here. I think, there's this clear distinction between a wallet that users are consuming directly, like a MetaMask, a Phantom, etc., versus kind of like what Fireblocks has done, which is a wallet as a service business. And this is very powerful because I still think there's a general question mark on whether 10 years down the road, people are still going to be using like the same wallet UX to interact with crypto. I think tough to say. But what's indisputable is that you will always need the underlying cryptography to operate on the blockchain. And you have this really solid cryptography infrastructures like Fireblocks that extend that cryptography via wallet as a service for a number of integrations. So I think that, when you're kind of really looking at this segment, the long-term kind of like compass, the North Star is how do you use what's a very complicated cryptographic technology and make it as seamless and as invisible as possible. And you're seeing that with Robinhood, you're seeing that with Bridge, you're seeing with many fintechs that, by the way, are like the largest customers of Fireblocks, because they're going to Fireblocks and they're saying, I don't want my customers to even know what a transaction is, but I'm ultimately dealing in crypto, and I want you to provide that wallet as a service, cryptography service, and extend it to support my operations. So I'm actually very excited to continue to see the UX evolution of wallets away from what we kind of know as wallets today into even more seamless things, to the point where you'll be able to use something that's crypto without even knowing that it's crypto, because the cryptography operations are fully abstracted from you.
How do you guys think about, if I had to maybe counter this, it's that, there's only a couple of main wallets in the industry today. It's probably Phantom, which kind of dominated Solana. Obviously, Backpack's doing well there too. And then MetaMask. And then there's a couple other players, but it's really dominated by them. But now you're seeing people kind of trying to verticalize the stack. So, Coinbase launched their own wallet. Uniswap launched their own wallet. If you are a big project or application, you want to own the wallet layer too. So there's going to be mass competition in this area. How do you think about that from the investor's lens?
Kevin, you want to?
Yeah, like my sense is that there is very purpose-built apps that provide specific features. But like if you are I actually inevitably think that that's going to be more the case, where like you have a particular provider that wants to deliver a particular user experience that's supported by their own application. I think the generalized wallets may kind of have to kind of fade away, because it will become more, people will want to go to a UX that has a very specific application of what they're delivering. And I go back to Fireblocks being a great example of that, where Robinhood, for example, uses Fireblocks on the back end to deliver the user experience. And you would ask yourself the question, like, is that a Robinhood wallet, and in many ways it is a Robinhood wallet that wants to deliver a particular experience. Same thing in the way that Coinbase, even though they run their own cryptography, they're delivering a very particular experience to their users based on that. So I'm actually not surprised at all that this is the case, and I expect it to continue to kind of like, that trend to continue.
Nice, cool. Back to you guys.
Yeah, so let's talk about one of the most interesting questions in the space, where like we think Solana will reach parity with Ethereum. So we think yes. We believe that for our 8 prediction that Solana will reach parity with Ethereum as measured by obviously activity.
Oh my God, Kevin, you're killing me with this one. I'm getting the Slack message. I'm getting blown up right now because people are saying Blockworks is running a targeted cutthroat campaign against Ethereum funded by Solana. Yeah. So you're not going to help me out with this right now.
Yeah. Well, look. I think some facts are maybe indisputable. Let the market judge by themselves. But
I'm sorry. Go ahead. Go ahead with your prediction.
We believe that Solana will reach parity with Ethereum as measured by activity and market cap. So, and I'll tell you kind of why I think that. So, let's kind of first start with let's kind of level set for a second. On Christmas of 2022, after the FTX collapse, and this is what I'm showing on the left-hand side chart, Solana's market cap bottomed at 3.6 billion. On that same day, Ethereum had 146 billion market cap. So that was around a 40x difference between the Solana's market cap and Ethereum's market cap. Since then, and by the way, this was cut before this latest rally post election, that spread has gone from 40x to only 6x. So massive outperformance from Solana. It's really a massive comeback. Market cap is a very easy thing to compare. If we actually look at the other metrics, whether it's TVL, Ethereum's still the king of TVL. It has roughly 10 times the amount of TVL that Solana has, and primarily because of like Ethereum DeFi and stablecoins, which are predominantly still in Ethereum. But if you kind of go down the list, you see that 30-day volume is roughly 2/3 compared to Solana, and then you kind of go down. You actually start to see the numbers, the story change rapidly, and you start to see Solana put this massive numbers. So what to me, kind of like what I kind of look at this data is, I see two things. One is that Ethereum and Solana, from like a pure KPI metrics perspective, they're not apples to apples comparisons. They're hard to compare because they're fundamentally different architectures. Solana, so like comparing daily active addresses or number of transactions is not apples to apples. But what you can tell is the growth rate of the KPIs. So let's go to the next slide. And, I like to kind of say that maybe Solana is a blockchain with very high velocity of money, fast transaction and high throughput, whereas Ethereum has really succeeded as like this lower throughput, more liveliness type of blockchain that, serves great for certain cases. But what's become clear is that there's been an increasing preference for less statefulness in some cases and higher throughput and higher velocity for many financial and blockchain applications. So let's look at this. So I mentioned in the prior slide, I mentioned that the 30-day trailing DEX volume was about 2/3. But for the first time ever, earlier this summer, the Solana managed to actually eclipse the DEX volume of Ethereum for the first time ever. So, the other things that you're seeing is Solana ETH trading volume. This is actually one of my favorite charts. I'm talking about the amount of volume that the native token SOL or ETH trades relatively. ETH has an ETF already. And despite having an ETF, and by the way, just to contextualize, like the ETF creates underlying trading activity on the native token ETH, Solana doesn't have an ETF. And what I find amazing is that on a year-to-date basis, SOL is only 1/4 behind ETH's volume. So it's done 1/4 of the volume with ETH than ETH has done on crypto exchanges without having an ETF. So in many ways, like what this is really signifying is the amount of demand, both from retail and institution, that there is behind Solana trading and SOL appetite. And like if you kind of look across the rest of these charts, whether it's monthly transactions or stablecoin volume, ETH still has higher absolute numbers, but the rate of growth of Solana across the KPIs is increasing. It's a higher derivative than Ethereum. So the kind of, if you ask yourself your question, like, why is that the case? Why have we seen a major shift from ETH as the main chain to Solana as the main chain? And if you look at the next slide, really, I think you have to zoom out and ask yourself, Solana has really emerged as this more pragmatic, builder-centric blockchain versus Ethereum has been more, you can argue, like more focused on infrastructure and academic research. But it's really about this trends, which is Solana is positioning itself to ride this major secular and macro trends, whether it's AI, whether it's mobile, AR, VR, financial services. Like, for example, like they launch, some people think it's like, a marketing ploy. Some people think that there's actually legs to this, but I actually think it's really interesting that Solana has been one of the few blockchains that's had a mobile strategy. Like they've launched the Solana Saga phone, which sold out less than a year. It launched Seeker earlier this year, which has 150,000 plus reservations. And when you think about how the barriers to entry to interact with crypto directly, having mobile-centric interfaces that allow you to interact with these blockchains is a major breakthrough. So, in my view, is Solana is differentiating itself as a community that can ship products that can address real use cases across big secular trends. And I obviously don't have time to go into every single reason, but there's very few inherent foundational and architectural differences why Solana cannot deliver the same type of services and applications that Ethereum delivers. And the fact that there is this 4 to 5x spread in market cap just doesn't seem right. So we expect that spread to continue to converge to one another, whether it's Solana going up at a faster rate than Ethereum, or Ethereum kind of coming down to meet Solana somewhere along the way.
Jason, hopefully we're not getting you in trouble.
Now that it's maybe it's ParaFi is running a targeted campaign funded by Solana too. No, this is great, guys. This is great. I know obviously Santi, you guys used to work with Santi, and I know if you were on here, he would be falling out of his seat for this. So no, this is great.
Okay, so let's go to prediction number 9. So our prediction number 9 is, I'll just read it and then we can talk about it. So 98% plus of digital assets will underperform Bitcoin. Less than 2% will outperform, but the ones that do will outperform Bitcoin very meaningfully. And so you may kind of like look at this prediction or hear this prediction and think that we're bearish or we're Bitcoin maximalists. We're not. Basically, our view is that there's massive return dispersion in crypto, and we think that this is an alpha-rich asset class. So if you can dig through the data and find the 2% of winners, there is meaningful alpha that can get created, and this is just a function of the power laws in crypto being more extreme than traditional venture. So you have fewer winners, but those winners are much, much larger in terms of order of magnitude. And this is a function of the fact that it's trivially easy to launch a network or launch a token. I think most days there are like thousands of meme coins that are created, and most of them are spammy and go to zero. But it's actually not too dissimilar in with utility tokens or at the application layer, infrastructure layer. So we think that it's a function of that. And then the second thing is the majority of altcoins are just very poorly designed from an incentive standpoint. And most human capital in the space is just not set up to sit and work on one project for a decade plus. Once like a 4-year vesting schedule is over, or by the time it's towards the end, they're launching their next project because it's more EV to just keep on launching things rather than stick with one thing for a prolonged period of time. If you look at all of capitalism in Web 2, the biggest companies in the world, Apple, Meta, Amazon, these are companies that were built over decades and where you had investors and founders that partnered in private markets with a long-term view where there was no liquidity in sight until you went public. And so for us, it very much like is a matter of incentives as being like one of the most critical problems in the altcoin space. And here we have a quote from Office Space, where Peter Gibbons was like asked to come into the office over the weekend to do his TPS reports. If anyone hasn't seen Office Space, please watch it. It's probably top 10 movie of all time in my opinion. But this is really like a classic kind of show me the incentives and I'll show you the outcome problem, because in this space, there are no like W-2s or performance reviews, or this isn't Blockworks, like a very well high functioning run media company with employees and promotions. And this is like the Wild West from a human capital standpoint. And so, on top of that, you don't have boards of directors and you have companies that go public, kind of quote unquote go public much earlier than they actually have users or find product market fit. So imagine if, the restaurant on your corner, the mom and pop restaurant, like had a stock that traded 24/7. Well, that's what most of the tokens that are listed are like today. So we did a little bit of data crunching at ParaFi to tease out this kind of concept or hypothesis. And we looked at, we went back to CoinGecko on January 1st of each of the last 4 years. And we looked at that top 100 token cohort on January 1st of that year. And we stripped out things like stable coins or staked ETH, like we focused on actual tokens that move. And what we found was that in each of the last 4 years, Bitcoin has outperformed the median top 100 altcoin. In each of the last 4 years, in 3 of the last 4 years, Ethereum has outperformed the median top 100 altcoin in all 4 of the last 4 years. But there's an important but here. The top 10 median altcoin, so like kind of the 5th best performing altcoin, outperform Bitcoin and Ethereum every single year. So this is just another way of saying there is alpha in this market, but Bitcoin and Ethereum will still outperform, or have historically outperformed the vast majority of tokens. And again, past performance in these historical performances of tokens is not reflective, doesn't imply future performance or guarantee it, but this is what we've observed empirically, kind of looking backwards. And here's another illustration of that same data set, but actually kind of stretching the data out further and examining these cohorts over much kind of longer periods of time. The other kind of problem, and I think Bell Curve and Empire and Blockworks has done a great job kind of digging into this, is just the idea of low float, high FDV tokens. And it's been a problem. One could argue it's a problem, or maybe it's not a problem, but what's undeniable is most venture-backed tokens launch, which are a very small percentage of their tokens in the float. And once investor cliffs happen and team cliffs, the market gets flooded with supply. And so as we kind of look at this data, what we've spread here is these 5 projects have raised, and we've kind of picked these out of a cohort. There's nothing special about them in particular, but they raised $1 billion of venture capital. They've anywhere between 4 and 26% of their token supply in the float, so very low percentage. Just these 5 projects alone have $7 billion of unlocks coming in the next year. And I would argue that most of these projects don't have what would be described as kind of strong product market fit. Maybe there's an exception on the page or two. And notwithstanding that, the founders and of all these projects are kind of like billionaires on paper. So I think there's like this weird incentive in this industry to to kind of have a high token price. And it's unclear if that's the way we kind of really grow as an industry. This unlock problem kind of goes out as far as the eye can see. Here we charted out, roughly 70 tokens, their unlock schedule in the coming quarters. And what you can see here is, there's roughly between $2.5 and $5 billion of unlocks of VC-backed tokens every quarter. The other issue here is whenever altcoin markets rally, the teams that have not yet had a TGE move to TGE because they look at their comps in the public market and say, oh, we should capitalize on this. This is no different than what happens in late stage venture and public equity markets. So whenever there is an altcoin rally, there's like a new launch or new launches, and that further adds to this maturity wall of tokens. And so this is supply and demand, and also this is why, candidly, the big question is who will buy these unlocks in a world where most institutions are entering the space through like one of these spot ETFs or through a crypto fund as an LP. Retail has kind of been somewhat absent this cycle. And so really it comes down to who is going to absorb these tokens. And that's why I think, protocols and applications themselves will become like the natural and arguably most important buyer of their own token. Very similar to what we've seen with, like MakerDAO as an example, with their token buybacks. So this is a problem, may or may not be a problem depending on how you look at it, but it's just also kind of like cold hard facts and data. Should we go on to number 10?
Yeah, let's go to the last one.
Okay, so if you're still with us, thank you. We're on number 10. We'll kind of close it out. This has been a marathon. So, we think about blockchains at ParaFi kind of very similar to countries. They're these kind of like self-contained kind of sovereign entities with value flowing between different constituencies. And you have different businesses that are built on these blockchains. And so we've kind of thought about this idea of kind of spent a lot of time thinking about and trying to calculate this idea of blockchain GDP to understand kind of the economic output of different blockchains. And, our prediction here for prediction number 10 is that blockchain GDP will grow to 1 trillion, which is approximately 1% of global GDP. And so kind of, let me just take a step back and describe kind of how we get there. And I'll be referencing kind of the slides that we've shared here. So if you think about GDP in the traditional kind of macro economy in real life, it's a function of a few things. It's consumer spending, investment, government spending, and then net exports, like what you export as a country, net of what you import. And that is generally how GDP is defined. So how should GDP kind of be defined in the context of a blockchain? Well, the way we think about it is there are two buckets. There's on-chain GDP, and then there's off-chain GDP. So what is on-chain GDP? It's this idea of, there are kind of two sources of on-chain GDP. There's what takes place at the protocol layer. So things like gas costs, MEV, transaction fees and tips. And then there's what happens at the application layer. So these are smart contracts or applications that are accruing value. Then there's off-chain GDP, and that's value that doesn't flow on-chain, but is indirectly generated through an on-chain product. So you can think about something like Tether, which is generating profits off-chain due to some on-chain activity. So that's our framework, but we wanted to attempt to quantify what that looks like today for Ethereum in particular. So I'll kind of skip over this slide, but here's kind of where we see Ethereum protocol GDP. So we looked at kind of gas costs, so ETH burned over the last 30 days, transaction fees and tips. So these are like block rewards paid to validators on the network, block builder payments made to validators, as well as consensus rewards. and kind of get to 3.3 billion of kind of protocol GDP. Then at the application layer, we looked at some of the largest earning applications, whether it's Lido or Aave or Uniswap, and we aggregated the revenue of those applications, and then looked at things like imports and exports. So the idea of like an import is certain blockchains have to import labor and services from the off-chain world. Like if you think about a sub-DAO on MakerDAO, that's a great example of that. And then there are things like exports, which is like layer 2 sequencer revenue or other things that would fit that category. So as we kind of blend those together, we think that Ethereum's on-chain GDP, and again, these are rough numbers that we've estimated, and we would welcome feedback on our framework. We estimate Ethereum GDP on a kind of a run rate basis on-chain is roughly $5 billion. About 65% or 2/3 of that is on-chain, is at the protocol layer, and about the remaining 1/3 is at the application layer. If we think about off-chain GDP, it's very difficult to quantify. I mentioned, Tether or Circle as examples of off-chain GDP. You could also consider kind of Coinbase trading fees, or revenue generated by Fireblocks is also kind of fitting this category. It's very difficult to quantify. I think arguably maybe even larger than on-chain GDP today. So that's our framework for GDP. And I think that, in some ways, like kind of just stepping back for a second, I think as an industry, kind of coalescing around a metric like this as like a North Star is pretty interesting and maybe something worthwhile, because I think what this metric measures is the usefulness of blockchains. Like if people are building like useful, pragmatic applications on chain where people are paying to use block space, this number will be higher. And if we can kind of like measure the growth over time and see that, the GDP of different blockchains is growing, I think that's a signal that like we're doing something right as an industry. And I know Blockworks has like actually like a very similar metric to this. I think total economic value, or Jason, what?
Yeah, exactly. Yeah, TEV. Yeah, TEV.
TEV. So like I think that so I think like, and maybe it's like very similarly kind of constructed.
We're thinking about it very similarly. Yeah.
So yeah, like that. I think, and so yeah, I mean that's like kind of the prediction that we have is like, look, if Ethereum's at 5 billion today, and maybe we add up all the other blockchains, maybe generously we're at 10 billion. To get to $1 trillion, that would be 100x growth. So I think that's a good goal for the industry. Hopefully, we're like well in excess of that.
Yeah.
One interesting scenario that we've seen in the past this year actually was with Uniswap and Unichain. So Uniswap was the top number one or the top number two gas consumer in Ethereum L1 for the past several years. Now with Unichain, that's moving to an Ethereum L2. So then and by the way, like all of that MEV, all of those gas fees, we're going to validators like ParaFi Technologies, for example, and other Ethereum validators that were capturing that revenue. Now the question is, when you move something from L1 that is high, revenue generating, to an L2, to like what we kind of deem as like this gray area of like off-chain sequencers potentially, or other off-chain worlds, like does the GDP kind of actually being eliminated? Is it being destroyed, or is it just simply being transferred into another form of GDP? And this is actually a really interesting question that exists, that's very unique to crypto, because very, very nuanced business decisions and architectural decisions can make the difference between, even if the function is exactly the same, the user experience is the same, a minor decision of whether you're running on an L1 or L2, or whether you have an off-chain sequencer or not, could actually drive orders of magnitude of GDP difference to our metrics because of how it's being quantified. So I think we're in the very early innings of this GDP definition and how it actually is going to continue to evolve. But I ask myself that question: is like, where are all the fees that were generated by Uniswap and L1, now that they're now in a Unichain L2, who's really going to be the beneficiary of that? How is that value, consumer surplus, being transferred from an L1 to an L2 amongst the cohort of user participants, from traders, validators, liquidity providers, and Uniswap, holders as well?
Yeah. Yeah, it's like I wonder if like ETH L1 and L2s could be thought of as like, like NAFTA, like is it like the US, Canada, Mexico, or is it like the federal government and the states, or is it, US and like Puerto Rico, like a protectorate? Like is it, it is a interesting, I mean, it is an interesting question that Kevin has posed.
Yeah. Guys, one of the longest Empire apps we've ever recorded. There's still one question I have that was not covered in these 10 predictions. Be very curious to get your takes on you've got honorable. Will you actually rip through these honorable mentions, just one line for each?
Just quickly, we've gone through 10 predictions, but we actually have, many more, and we wanted to kind of quickly go through some honorable mentions. We have 10 others, so Kevin and I will just read them. We're not going to like talk about them, but we'll just kind of like read them for your entertainment. Okay, so prediction number 11. ZK Tech will transform privacy and scalability across the blockchain space, but most of the existing venture-funded teams won't cross the chasm.
Prediction 12. The Bitcoin mining to AI high-performance computing data center conversion story is really just in the first inning.
Prediction number 13. 20% of governments globally will own Bitcoin by the end of this decade.
Prediction number 14. 10% of countries will have adopted CBDCs at scale.
Prediction number 15. Permissioned DeFi activity will exceed permissionless DeFi activity by 10x.
Prediction number 16. Crypto collateralized lending will come back to 10x the size of the 2021 cycle.
Prediction number 17. On-chain messaging will begin to disrupt email, Telegram, and WhatsApp.
Prediction 18. This is one of my favorites. Bitcoin mining will drive the next major wave of renewable energy adoption.
I like that one.
Prediction number 19. The Ethereum 0x000 address will be exploited within our lifetime.
What does that mean, Ben?
So this is like the burn address on Ethereum that people like send.
Oh my God, that would be insane.
Yeah, like this tens of millions of dollars, billions of dollars of
more than that. Yeah.
Tokens in a single address just sitting there, and you only have 2 to the 256 probability of getting that just in the same way that you get any other address. So I think it's a very bad architectural decision that many tokens adopted.
I never thought about that. That's interesting.
And then the last one is,
wait, why is that a bad? That's almost like it's
because they should really be implementing a token burn. So like the actual token is fully removed.
I know, but isn't this kind of like a fun lottery system? It's like
the token supplies of all these burns would all of a sudden get like massive. It would be like a massive debasement event.
Yeah, you're right.
It would increase the Gini coefficient of the space because one person would get like a massive amount of money.
I know, but that would be so fun and so entertaining, guys. That's what you're not thinking about, the entertainment value, Kevin.
You have the media. You have like the media.
Yeah, I think there's like I haven't looked at it a little bit, but like MakerDAO used to like burn its Maker tokens to that address versus like fully removing it.
Yeah, no, I know it would. Yeah,
it would be highly entertaining for if you don't have skin in the game, but like highly chaotic and disastrous for those that like actually have to figure out what to do with these things.
Okay, so what's the last one here?
And then the last one is that at least one major war will be fought over Bitcoin's strategic national reserves.
Can you tell me more about, okay, so 20, at least one major war will be fought over Bitcoin strategic national reserves, and then 20% of governments globally will own BTC. I think the most, we're recording this November 15th, and it won't go out for another like probably 10 days, I think. So, we'll see what happens in the next 10 days with the strategic Bitcoin reserve. But, I think one thing that is, I think the most important poly market actually right now is the 32% chance that we create a strategic Bitcoin reserve. Like that is the single most
I think this
important.
actually jumped since you last looked at it. I think it's close to 50 now, but yeah.
I think it jumped to 50 and then came back down, funny enough. But yeah, I'd love to hear your guys's, maybe just expand on that, because that's kind of one combined prediction there. I would argue, like maybe just expand on that.
Well, I'll like just talk about, yeah, I mean, Kevin could talk about the major war part or the other part.
Or we can skip the war, but maybe just like tell me your thesis around governments owning Bitcoin.
For me, it's like, look, there are 195 countries globally. So 20% of that is like 40 ish. So, today I would say they're probably, you have El Salvador, you have Bhutan, you have like Germany. I mean, Germany and the U.S. government and some governments own Bitcoin, but not by having bought it. I think this prediction, if we're kind of like refining it a bit more, is like we think governments will like proactively own it or want to own it / hold it. And I think in my mind, there's a lot of game theory at hand here. If the U.S. adopts a Bitcoin a strategic national reserve, the game theory is that other countries will, by definition, like kind of almost like need to follow. And, there is a big advantage to being a first mover in that process versus like being like the last country globally to adopt. And so this is why I think the world can change very quickly in a very short period of time with that kind of like a paradigm shifting decision where, where basically people have to be fast followers with the US. But let's say the US doesn't buy, right? If we start getting smaller countries defecting from the dollar or choosing to hold even a low single digit or mid single digit percentage of their reserves in Bitcoin, that starts to compound and create like this waterfall effect. So yeah, I think that it's inevitable. And actually, sorry, last thing I'll say is I don't think we end up at 20%. It's almost like either it's like 5% or 100%. It's not going to be in like the middle. It's either going to, I think it's more of like an all or nothing kind of concept.
But by the way, and there's game theory as you're buying, but also the flip side of that game theory is that if you're a country and you want to build a strategic reserve, you should actually tell no one that you're doing that. You want to be quiet and hush behind the scenes, because as soon as it becomes known that a major country is building a strategic reserve, in many ways, I think it kind of puts us back to like the space race. It's an arms race to other countries building that, and you're ultimately fighting and being outcompeted in price. So you actually want to keep kind of like a relatively low profile in that sense. But to the point of like
Kevin,
why is Bitcoin?
Kevin, do you want to hear on that point? I went on Fox yesterday they asked me to come on Fox Business to talk about the strategic Bitcoin reserve, and the producer was talking to me behind the scenes before going on. He's like, what's the most interesting thing in the markets right now? I said there is nation state game theory playing out. This is game theory at the highest levels of asset allocation. The US is being front run on a Bitcoin strategy because we've essentially telegraphed to the world that we intend to buy this asset that's in scarce supply. But right now we don't have the concrete ability to do so. So the dynamic in the market is that if you're a large holder, you're seeing bids from these even larger holders or even larger non-holders who are anticipating what's coming, and they're basically trying to grab the exposure before you do. It's a super interesting just situation happening in the markets.
Absolutely. And by the way, just on prediction number 20, on like we believe that at least one major war will be fought over Bitcoin's national strategic reserves. If you kind of just look at history and you ask yourself, what are the things that nation states and countries fight about? It's in the modern day now, it's chips, right? Like there's this big geopolitical tension between China, Taiwan, and the US, and like where our chip production comes from. And the CHIPS Act that was enacted by the Biden administration to bring US manufacturing of chips into the US. And that chips and compute are a key component of Bitcoin. The second thing, energy. Energy is something that has been, oil in the past has been globally fought over many wars. And what is crypto particularly good at or depend on? Energy infrastructure, energy sources. And then the last thing is, what is Bitcoin? Bitcoin is money. It's a financial asset. It's a reserve asset. So you combine these three massive geopolitical forces: compute chip production, energy infrastructure, and a financial asset that's non-sovereign. And you have like the perfect combination, the fusion of every single kind of scenario to create what I actually think is it's a potentially a war like geopolitical incentive to control those assets. Because if you control those assets, you're in many ways by definition a prosperous nation. So I think we're in the very, very early stages of nation states waking up and realizing that they have to be energy self-sufficient, they have to be energy independent, they have to have chip manufacturing completely independence from China and Taiwan, and that you ultimately want to be somewhat decoupled from kind of like global currencies that dominate trade and global trade. And you're seeing that with BRICS already, with like Asia, China, Russia, Iran launching the kind of decoupling from the dollar. And I think the other asset that's going to play a role there is going to be the dollar, some BRIC currency, and you're going to see Bitcoin up there. So
I love. I could not agree more with you guys. I love this. I mean, it's just a commodity that the world is going to want, and like it's actually tied in with your with the power grid one, and like Bitcoin, like our power grid is so screwed right now, and I think so. Anyways, we're at 2 hours. I'm going to cut it off. This is great. Kevin, Ben, thank you guys. I know you're doing a similar type of conversation at the Digital Asset Summit. Ben and Kevin will both be there. It's March 18th to 20th. So you guys should get your tickets. That's my marketing plug to make the marketing team happy. So Ben, Kevin, thank you guys so much. I appreciate the time.
Thank you, Jason.
Thanks, Jason.
Hey everyone, thanks for watching today's episode. Just wanted to quickly thank today's title sponsor, SKALE. SKALE really is one of the best chain experiences out there today, and I've used so many different chains. There's a reason they are gaining so much adoption in both gaming and AI use cases. Hit the link in the show notes to explore the SKALE ecosystem.